You don't need thousands of cedis to start investing in Ecobank Balanced Funds. In fact, the published minimum initial investment is just 20 Ghana cedis, with subsequent investment from 10 Ghana cedis. But here is the question nobody should ignore. If you put your hard-earned money into this fund, how much could you realistically make, and what are you actually paying to have your money managed? The fund has been around since 2009, and it has generated some impressive returns over the years. But it has also experienced years when returns were much lower. So, today, we are going beyond the Ecobank name. We are going to look at how the fund works, its historical performance, fees, risk, and who it may actually be suitable for. By the end of this video, you would have enough information to decide whether the Ecobank Balanced Fund deserves a place in your investment portfolio.
Unlocking Africa's Wealth Code, Money Code Africa.
Welcome to Money Code Africa. First, let's clear up one important misconception. The Ecobank Balanced Fund isn't a normal Ecobank savings account. It's a mutual fund managed by EDC Investments Limited, Ecobank's asset management business. Your money is pooled together with money from other investors. The fund manager then invests that money across different assets, including fixed income securities and equities. And that's where the word balance comes from. You are not putting everything into stocks, and you are not putting everything into fixed income. The idea is to combine different types of investment to pursue growth while managing risk. The fund was launched on 30th March 2009, so it has a relatively long operating history. This is probably the most important thing to understand. The fund's current information describes a portfolio targeting approximately 50% fixed income, with the remainder primarily in equities, subject to its permitted allocation range. That means your money can benefit when the stock market performs well, but you also have exposure to fixed income investments. The fund's benchmark is particularly interesting. It uses a combination of 50% Ghana Stock Exchange Composite Index and 50% Government of Ghana 364-day Treasury Bill. So essentially, the fund is trying to provide a middle ground between growth and stability. And that also means we shouldn't compare its performance only with the Ghana Stock Exchange. If the GSE goes up 50%, you shouldn't expect a balanced fund to automatically make 50%. Why? Because you are not invested 100% in equities. Now, let's get the numbers. According to the EDC's 2024 annual report, the fund recorded a return approximately 23.59% in 2024. The SEC's 2024 annual report gives a slightly different figure of 23.81%, so there is a small reporting difference. But here is what makes the story interesting. The fund hasn't produced 20+% returns every year. For example, the historical figures published by the EDC shows approximately 2021 30.7%, 2022 9.4%, 2023 4.52%, and then performance improved significantly in 2024. So if someone tells you just put your money in this fund and you will make 20% every year, don't believe them. Investment returns fluctuate. Some years can be excellent, others can be very disappointing. And that's exactly why we need to look at the long-term picture, not just one good year. Now, here is one of the most impressive statistics. The June 2025 EDC fact sheet reported a cumulative return since inception of approximately 905.98%. The reported compound annual growth rate was around 15.2%. According to that fact sheet, a hypothetical 1,000 Ghana cedis invested at the inception would have grown roughly 10,059 Ghana cedis. Now, that sounds fantastic. But let's pause. This does not mean you should expect 15.2% every year from now on. Past performances is not a promise of future performances. And there is another question we have to ask. How much of the return is left after fees and inflation? Because that's what matters to you as an investor. This is where many beginner investors don't pay enough attention. According to the June 2025 fact sheet, the fund had a 2.5% annual management fee. There was no subscription fee listed, but there is a withdrawal charge if you exit early. According to the published fee structure, year 1 withdrawal, 3%, year 2 withdrawal, 2%. After year 2, 0%. Think about that carefully. If you put money into the fund today and suddenly you need it a few months later, you could be penalized for withdrawing early. This is one reason the fund isn't designed for emergency money. The fund itself recommends a minimum investment horizon of around 2 years. So don't put your rent money, school fees, emergency fund, or money you need next month into an investment simply because you are chasing returns. Here's where the fund becomes interesting for beginners. According to Ecobank's current information, the minimum initial investment is 20 Ghana cedis, and the subsequent investment can start from 10 Ghana cedis. That means you don't necessarily need 10,000 Ghana cedis or 50,000 Ghana cedis to start investing. You could potentially begin with a small amount and build your investment over time. I think this is the important lesson for young Africans. Sometimes the biggest obstacles isn't the investment product. It is our belief that I will start investing when I have enough money. You don't necessarily need to wait for thousands of cedis. What matters is building the habit while you are increasing your income. Now, let's address the question many people are thinking. Is my money guaranteed? No. A balanced mutual fund is an investment. It is not the same thing as putting money into a guaranteed deposit. Because the fund invests in securities, the value of your investment can rise or fall. The equity portion is exposed to stock market movement. The fixed income portion is also exposed to risk, including developments in Ghana fixed income and sovereign debt markets. Remember what happened during Ghana's debt restructuring? Fixed income does not automatically mean risk-free. And the fact that a fund is regulated does not mean you cannot lose money. Regulation is important because it provides a framework for how the investment manager operates. But investment risk still exists. One of the biggest advantages of balanced funds is diversification. Imagine you're a beginner. Instead of researching individual shares, government securities, corporate bonds, and other investments yourself, you are buying into a professionally managed portfolio. You aren't dependent entirely on the stock market, and you aren't dependent entirely on treasury bills. The fund manager makes allocation decisions within the fund's investment mandate. For someone who doesn't have the time, knowledge, or confidence to build a diversified portfolio themselves, that can be useful. But remember, diversification reduces concentration risk. It does not eliminate investment risk. So, who might consider a full fund like this? I'll put the potential investor into 4 categories. Number 1, the beginner investor. If you want exposure to both equities and fixed income without personally selecting every security, a balanced fund can be worth investigating. Number 2, the long-term investor. If you are investing money you don't expect to need immediately, the structure makes more sense. Number 3, the regular saver. Someone who can consistently invest 50 cedis, 100 Ghana cedis, 500 Ghana cedis, or more every month could use the fund as part of a disciplined investment strategy. Number 4, someone looking for diversification. Instead of having all your investments sitting in one asset class, a balanced fund gives you exposure to multiple types of securities. But who shouldn't be rushing into it? Someone looking for guaranteed returns. Someone who needs the money very soon. Or someone who hasn't built an emergency fund yet. Now, here is the part I want you to pay attention to. The historical performance is attractive. The minimum investment is accessible. The diversification is useful. But fees matter. A 2.5% management fee every year isn't something you should ignore. And that's why when comparing this fund with another investment product, don't simply ask which one made the highest return. Ask what did I get after fees, inflation, and taxes, and how much risk did I take to get it. That's a much more intelligent way to compare investments. Because a fund making 18% with lower cost could potentially be more attractive than a fund making 20% with a substantially higher cost. So, is the Ecobank Balanced Fund worth considering in 2026? My answer is it can be, but it's not automatically the best investment for everyone. It has several attractive characteristics: a long operating history, diversification, low entry requirement, professional management, and a strong long-term historical performance record. But it also has investment risk, management fees, early withdrawal penalties, and no guarantee that historical returns will continue. So I wouldn't tell you put all your money here. That's not investing. That's concentration. Instead, understand what you are buying. Understand the risks. Compare alternatives and decide how it fits into your overall investment strategy. Now, I want to hear from you. Have you invested in the Ecobank Balanced Funds before? If yes, tell us in the comments. How has your experience been? And if you haven't invested yet, tell me, what is stopping you? Lack of money, lack of knowledge, or fear of losing your money? If you want to do a side-by-side comparison of Ecobank Balanced Funds versus Treasury Bills versus Money Market Funds versus the Ghanaian Investment Fund, compare them. If enough people ask for it, that's the next video I will make. And remember, don't invest because someone tells you an investment is good. Understand where your money is going. Understand the risk. Understand the fees. And understand how your money is supposed to make money. This is Money Code Africa. Subscribe and turn on your notification because every week we are breaking down the numbers behind money, investing, and wealth creation in Africa. Thank you for watching, and I'll see you in the next one.